You're listening to Seattle Real Estate Podcast.
Red hot housing market drives biggest home equity drawdown since 2007. What is a home equity drawdown? Well, it's a home equity line of credit, or it's a cash out refinance where property value has grown. You take out a little bit more debt, and maybe you take out some more of that debt as cash that you buy whatever it is that you want to buy. On the Reynolds and Klein side of things, one of my businesses, we've been doing a ton of appraisal work for cash out refinances or appraisals for home equity line of credit, although those loans have kind of gone away, mainly because we had that whole Great Recession deal and a lot of HELOCs, the home equity line of credits. They got people a little bit overextended, but rest assured, we've been told that the market is fundamentally sound and it's not going to have a big decline, even though people have been taking out record numbers of these home equity drawdowns since 2007. That's what we're talking about today. If you're new here, welcome. My name is Sean Reynolds. I own a couple of real estate companies. I own a real estate brokerage. We sell real estate here in the greater Seattle area. Then I own Reynolds and Klein Appraisal. It's an appraisal company. We appraise homes, sometimes for people taking out cash from the equity of their homes. Homeowners are tapping into their property's equity to fund renovations, invest in stocks, and more. If you are taking money out of the equity of your home and investing it in the stock market, I don't know. I'm no financial guy, so don't take my advice. But that is a slippery slope to me. You let it sit in your home. All right, you cash out when you sell the house. You're on equal footing. So you take out a bunch of money and you buy a bunch of stocks that go sideways on you, or we have a big dip. Not a good call. But far be it from me to tell you how to spend your money or spend your equity. And what's crazy is that we can kind of conceive as our homes as piggy banks now. Property value goes up. You go to the bank. They send an appraiser out, like somebody like Reynolds and Klein Appraisal. Numbers come back. Sometimes they'll even just look at, your assessed value. You know what they never look at for any of these loans? Zillow, the Zestimate. That's a no-go. They'll look at assessed value. They'll look at, an appraisal. Those are things that, actually back value a little bit. The assessed value goes through a mass appraisal process, and the actual appraisal goes through the appraisal process. So homeowners are taking advantage of a global housing boom by pulling equity out of their homes at the highest volume since the financial crisis. And that makes me nervous. Why? Well, anytime you've got this, record setting level of this, record setting level of that, that's when you think, okay, is this the end? And yet we've been talking about this for basically years now. Just the pandemic is just squeezed gasoline on that fire, and it's just roaring, isn't it? In the U.S., homeowners withdrew $63 billion in equity from their properties through more than 1.1 million cash-out refinances in the second quarter of the company. What is a cash-out refinance? Well, you basically two different kinds of refinances. You've got a rate and term refinance, which is you just say let's just say you've got a 4% interest rate and current rates are at 3%. Well, and maybe you change it from a 30-year loan to a 15-year loan. So you've got rate, you could drop your rate from 4% down to call it 3%, or you could change the term. So you've got rate and term. You're refinancing the exact same amount, your principal. You're refinancing that. In a cash out refinance, you are taking out a new loan to pay off your existing mortgage that you've already got, on top of taking out XYZ dollars more, up to a loan to value ratio of maybe it's 75% of the total equity or the total value of your property. And the value of your property by getting an appraisal done, or maybe your bank or credit union relies upon the assessed value, some metric other than Zillow, typically. It's not just Zillow. It's any of the computer-generated modules that may or may not be accurate. So homeowners elsewhere are also finding the idea attractive. In the United Kingdom, net equity withdrawals topped 13 billion pounds, about 18 billion US dollars at the time of this writing. And that's in the first half of the year. So in the UK, you've got 18 billion. In the US, you got 63 billion dollars. I mean, this is just extra money that the banks are issuing based on perceived equity. And I say perceived because what happens if the real estate, market drops, say 30, 35% in your community? Does this sound familiar at all? Anybody? That's exactly what happened during the Great Recession, right? And there were a lot of 1-year interest-only teaser loans being handed out like candy, where people bought in and they thought they were going to renovate the home and turn around and sell it within that first year. Well, what happened is they got that teaser interest rate that allowed them to get in because otherwise they couldn't afford the home. And then the property values tanked. They couldn't do anything with that home because now it's worth less. And they've got this big loan on it. They're upside down. So they're either going to do a short sale, meaning they coordinate with a bank and the bank says, okay, we're going to eat this percentage of loss. And you're going to eat all of your down payment and anything you've got into the home. You're just going to walk away. Or you do you try and sell the home somehow and maybe you get a short sale. If that doesn't work out, if the house is so upside down, maybe your lender just allows it to go to foreclosure. So those are a couple of your options in this spectacular scenario. But that's literally what happened in 2008. And, the lending industry was such that we went sideways for how many years after that? It was a lot. Crazy times. So Mike Reed, the founder of a copywriting agency in London, was one of these folks who took out a cash out refinance or a HELOC. He remortgaged his 3-bedroom apartment near Wimbledon earlier this year to fund a kitchen and bathroom remodel. All right, so if you're going to spend money, if you're going to take money out of your house, and if it makes sense, do a remodel to your house, because then you are actually possibly increasing your value by an equal or, it's not like you're buying a car that's going to depreciate. You're hopefully increasing that value, and that makes sense. So remodeling a home, I don't have a huge issue with that. But I think a lot of times letting your equity just run, and a lot of financial people say, well, but you're not using your money. Just let it sit there. When you sell it, take your tax-free up to $500,000 if you're a married couple, or we're talking capital gains here, or if you're a single individual taxpayer, take your $250,000 gain. Those are on the table right now. You can get those on the table. Those are options available to you for your primary residence, which you've lived in 2 out of the last 5 years. Again, I'm a real estate guy. I'm not a financial guy. Don't take my word. Absolutely. Check with your CPA, right? I mean, that's kind of goes without saying. So this guy, he funded a kitchen and bathroom remodel. In part, it's something I want for myself, he said. The 51-year-old also believes the value added to the property. All right, which he paid £655,000 for 2 years ago and will make up for the additional debt. So a lot of people think, well, I've got this money and I need to do this instead of taking cash out of my savings account or, selling some stocks and incurring capital gains. I'm just going to go ahead and do a little, cash out refinance or throw a HELOC on there if that's a possibility. And then do your remodel. With borrowing costs at rock bottom levels, he was able to tack on £30,000 to his mortgage at a 1.54% rate, fixed for 5 years. That is, if you're under 2%, that's crazy low. It's stupid low. And that's why people are, doing this, because it makes sense. Where else? What other time period in history you can be able to borrow money, and it's secured by your home. So what the lender is saying is that, well, we believe that our risk is low because we see the market continuing to move forward. This is your primary residence. If this were a non-owner occupied, wildly different deal, probably wouldn't get these kind of loans on it. And that's because they are banking on the fact that you will give up your non-owner occupied or your rental property, before that roof over your own head, you're gonna, the best bet for the lender is your owner occupied residence, right? So I'm conscious that there is a risk. I can't guarantee that the value will go up to cover the extra expenses, Reed said. But living in London, I'm confident that prices will creep up. That's what I think a lot of people are thinking, especially in the big urban cities, like a Seattle that has an employment, sector that doesn't seem to be slowing down. Talked with somebody the other day, Amazon employee, and one of the big things is, when are they ever going to go back to the office? When are these tech companies ever going to go back to the office? Is it sometime in 2022? Because a lot of people are waiting to make their decision on, well, how much time are we going to spend at the office? Because if it's only 2 days a week, that makes a big difference to whether I can move further out or I need to be closer in to the office. We just don't know what a lot of those scenarios are looking like, because the big tech companies, especially here in Seattle, they've been like, it's a work in progress. We don't really know. They've been saying, all right, you're going to go back to work April of 2021. You know what? It's too soon. July of 2021. Definitely by December 1, 2021, we're all going to be happy campers back in the office. That's what we're doing. You know what? We've got to revise that. We're going to reanalyze. We're going to rethink. And we don't know when you're going to go back to the office. So that has had an impact on real estate here in the Seattle area, and also other areas that have a big sector of tech workers. So, okay, let's keep going here. An astonishing surge in home prices over the last 18 months has convinced other homeowners to do the same. Take out a little cash, do that kitchen remodel, whatever it is. Buy that Ferrari that you've been dreaming of. I mean, treat yourself. You deserve it, right? That's what an old school managing broker would do of a real estate brokerage. Go out and buy the most fancy Cadillac you can. You deserve it. Your business is going to go up, because when people see you rolling up in that Caddy, maybe that Lincoln, they're going to think you're the cat's meow. They're going to buy some real estate from you. And the owner of the brokerage, he knows full well. And when you get in some payments, you get in some debt, you're going to have to work your way out of that. And so you're going to probably be a little bit more inclined to sell just a little bit more real estate. Glengarry Glen Ross, right? I mean, have you seen that movie? If you're in real estate, you've seen that movie. It's a good movie. It's crazy. Alec Baldwin had a great part in that. It was pretty cool. Plus, ultra low interest rates are making it possible to secure cash out refinancings and end up with the same or sometimes lower monthly mortgage payments. That has been a trend. All right, I'm borrowing more money, but my end payment is going to go down because they started with a higher interest rate. Granted, it was at a lower loan amount, but the difference now between they're taking their existing mortgage, they're adding a little bit more, taking that cash out to do whatever. They've got a greater loan amount, but the difference is their interest rate is substantially lower than what they had on that first loan amount, right? So their payment goes down. I mean, yeah, it is not surprising. It's not shocking at all that people are doing this in droves. And all that money is just pumping through the economy. People are buying whatever. Maybe they're buying stocks. Maybe they're buying that Ferrari. Maybe it's a Lambo. I'm not really sure. It's a luxury car. It's it's fancy. Maybe it's a McLaren. I don't know. Maybe it's a Corvette. Just always seems like a bad idea, unless it's like a mid 70s or maybe an early 70s, late 60s Corvette. Those are just cool. While taking advantage of the extra cash may seem like a no-brainer, it's far from a risk-free option. Homeowners are ultimately increasing the debt load on their property and shrinking their available equity because they've already borrowed it. They've already got it. When they go to sell the house, they're going to have to pay whatever they owe, loan amount back. If housing values were to fall, they're never going to fall. What are you talking about? That is blasphemous. Real estate market going down? We have forgotten what that is like. We are all systems to the moon. That's what it seems like, doesn't it? And that makes me nervous. So, because what goes up oftentimes does come down. Maybe not all the way. Sometimes it does. The Great Recession showed us, big up, big down. That can happen. So if housing values were to fall, that could leave them owing more than their property is worth, or with too high a loan-to-value ratio to refinance down the line. That's something that a lot of people found out the hard way, and I was on the front lines of that. What do you mean, Mr. Appraiser? My house is worth less than what I paid for it. How can that be? Well, your next door neighbor's house sold for this. Across the street sold for this. This one 3 blocks down sold for this. Therefore, Mr. Homeowner, your house is, and Mrs. Homeowner, your house is now worth whatever. And they were like, So what you're saying is our house is worth less and we can't take out any more money. Yes, that is correct. And, those are not fun conversations to have because they're not usually as civil as those, because somehow that is, as an appraiser, that is my fault for not somehow seeing the value in their home. Because everybody thinks their home is worth, it's their castle, and why wouldn't it be the greatest house on the planet? It's got all these great features that they custom put in that may or not be recognized by the marketplace. Probably not. Most of the time, any custom features not recognized for any value, sometimes negative value. In the case of like a big swimming pool in Seattle, where you can use said swimming pool 4 days a year, if you're lucky. No, it's not that bad, but swimming pool, that's a hard no-go in Seattle market in my books. You just can't. We just don't have enough sunny days where it's like really warm, where you want to go out there and just take a little dive in your pool in the backyard. Hot tub, different story. It's totally worth it. So the next section here is a home or an ATM. Is it a place you're going to live? Are you going to cash out, refi? Treat it like an ATM. Home equity loans had their heyday in the run-up to the financial crisis. Tempted by climbing values, homeowners used their properties as virtual ATMs to fund everything from fancy vacations to jet skis. Did people buy jet skis? I think they did. When values crashed, however, borrowers saw their supposed equity vaporize, because that is the downside. That isn't really explained to you, because why would property values ever go down? So when you're signing those cash out refinances, know that that is something that could potentially happen. I mean, just from a logistics standpoint, that could happen. You know what? And every single real estate market has those people that do this right at the tail end, and then they just get spanked the most. And those are the people, when you're appraising their home, they're like, my house is worth what now? Yeah. That's not good, is it? No. While equity withdrawals have jumped, they are way off the heights of those boom years. Americans cashed out $101 billion of equity in the third quarter of 2005. $101 billion, quarter 3, 2005, right before the Great Recession started. And this was the time period that really impacted that market, because things were happening willy-nilly that shouldn't have been happening, and yet they did. With nearly $40 billion more than in most recent quarter, at the same time, average national home values are now roughly 50% higher than in 2005. Those numbers to me are just crazy, because I thought we were crazy high back then. And then when we started to go past those numbers, and oftentimes what you'll do is you'll be appraising a home and you'll see the sales history of the subject property, because you want to look through and see what that home sold for over the years, kind of see the progression. It's yet another indication of the value you're coming up with today. All right, take today's value, back off 30%. We should be at this, they should have paid this at this point in time. And does that make sense? So it's kind of an indicator of value. I remember when we started to skip past values from 2005 in 2017, 2018, something like that. And we were kind of like, all right, are we going to have a dip at this point? We just cruised right on past, right? Just boom. We had some amazing property value increases here in Seattle in 2017, like a peak. We had a real peak there. Overall spending remains muted and credit card debt has fallen, suggesting that people remain fiscally cautious and aren't embarking on a consumption binge. Okay. And, that's relative to 2005. I see a lot of people taking out a lot of money, equity from their homes. And that's their choice. They've got to be able to manage that. But then you kind of worry, all right, is this going to have that massive effect across the marketplace? Is this one of those factors where we had this run for so long until the run wasn't a run? And after being in real estate for who knows how many decades, a lot, there's always an end to the run. It just feels like this one is extra long. Maybe it's a super cycle. It's just been this thing that we've been in, and you kind of keep wondering, all right, when are those wheels going to fall off of this cart? We're not too worried about this being a sign of excess, said Paul Dales, chief UK economist at Consultancy Capital Economics. How many other statements did you see by major banks? We don't think there's any, the fundamentals of the economy, they're solid. How many of those statements did you see like in 05, 06? And then by 07, they're like, you know what? We're seeing a little cracking in the foundation here. Maybe we need to have a little bit of pullback. There was some pullback, wasn't there? In an era of working from home and a dash for space, withdrawing equity may be completely rational if they are investing it by expanding their current home. Okay, maybe there's a lot of stuff there that's like, okay, that may or may not be the right call. Those are kind of tough to figure out. And I've been consulted as an appraiser on many of those. A lot of remodels don't pencil out. People do them anyway. And hopefully if they're in the home when the market's going up, they'll be able to circle back and be able to sell it and, get their money out down the road. The consultancy also points out that some of the surge will be a result of accidental home equity withdrawal, like when a mortgage is paid off and cash leaves the housing chain. The value of the money exiting will increase when sales volumes and prices boom. What's giving comfort to economists is the most ATM-like form of borrowing, revolving lines of credit, which usually carry variable interest rates, have actually dropped in the U.S., according to New York Federal Reserve, indicating consumers aren't just tapping into equity to top up everyday spending. All right, like a credit card based on your home. All right, you've got this equity. We're going to give you this credit card at this low interest rate. We hope you'll be happy, Mr. Consumer. Though some big banks, including the likes of Wells Fargo, did suspend new applications for home equity lines of credit in the pandemic. That happened right off the bat. Also, jumbo loans, boom, done. I think we were down to like one jumbo lender at the beginning of the pandemic because everybody just freaked out. I think that was Salao Credit Union. I'm going off memory there, but yeah, that was a wild. It just didn't make any sense. So that doesn't mean everyone is being sensible, the article goes on to say. Popular personal finance blogger Sam Duggan, aka Financial Samurai, says several of his followers have asked whether they should remortgage to invest in cryptocurrencies. I don't know where you stand on the whole crypto thing. I've made a little bit of money, but not because I was following any fundamentals, because it doesn't seem like there are any fundamentals with crypto. My older son would disagree, and I've got kids here working for me that would wildly disagree. Maybe I just don't understand the whole crypto thing. And I have crypto, I have a couple of accounts, and I've had some, and I've lucked out and made a little bit of money. By that, I mean like $5,000 after holding for who knows how long, because I bought at a peak and needed to wait the market out. No, I'm not a crypto trader. And I do not believe you should be taking out equity from your home and putting it in the crypto market. Maybe I'm totally wrong there, but that is my opinion. And that's all this podcast is my opinion. Nothing written in stone here, right? So I tell them no, the Financial Samurai says. Taking on debt to invest in a non-guaranteed return asset like crypto is a red flag. I wouldn't do that. Okay, I'm gonna say 2 thumbs up to Financial Samurai on that one because I totally agreed. A believer in the long-term potential of the housing market, though, the financial samurai, he himself jumped in, taking out a $1.6 million mortgage on a San Francisco home at a 2.25% interest rate to buy a second home nearby. All right, what do I think about that? Depending on what market you're buying in, if you are taking equity out of a home in, say, a San Francisco, and then you're going to, let's call it the middle of Wyoming, that may not, where appreciation is much slower. You're still probably going to have some appreciation when everything's going, but that appreciation slows to a zero or maybe a little bit of negative, depending on what happens with the market. Those kind of buys don't make sense. But if you're buying a second home nearby and you're already in San Francisco, yeah, you're doubling down, right? I mean, you're basically just taking money out. Now you've got two assets, one of which you can sell, the one you're not living in necessarily, or maybe you've just got a second home I need to go have some space from the family and go hang out at the second home. That to me, that kind of move makes sense. He has moved into the new house, which is larger, and is considering using the other as an investment property. Yep, I'm okay with that. I mean, there's something to be said, though, for paying off your mortgage or being able to pay off your mortgage or not having a big mortgage. And then financial people would say, you're sitting on all that equity. You should really do something. I am. I'm living in the house. So that's more in line with what most financial planners recommend, which is buying the second home and instead of taking out some kind of line of credit or cash out refinance and putting it all on red in Vegas. That's the other option. Why don't you just go take it and put it on black 11 in Vegas and, just see how that works out for you. Don't do that. Not a good move. Not a smart move. I'm a big believer, and if you've got equity in your home, let that ride till you need to sell it, then do that. Don't monkey around with it. But I'm old, and just there's so much work in trying to figure out all these investments and angles, and life is short. So if you got a little bit of money built up in your home and you're dying for that new kitchen, all right, run the number, see if it makes sense. Does what I'm spending, does that make sense relative to what other homes that are similar to mine with a remodeled kitchen? Is my home going to go from XYZ value up a little bit that'll at least cover the cost of their kitchen remodel? Maybe it's not right away, but maybe if you project a valuation a couple of years down the road and the market holds together, those are some scenarios where I'm like, okay, yep, that makes sense. If you're just dying for that new kitchen, what is it about kitchens? It's because we're cooking food and, you got to be in there with dishes and stuff. Or is it you're standing around looking at that workspace so much? We're dying to have nice kitchens, aren't we? Yeah, it's a thing. Can't tell you how many homes have been sold through Summit Properties where the number one consideration is, and this is when it's all over. The wife walks into the house. I love this kitchen. It's all over. Sign her up. They're going to buy it. And that's what happens. It's one of those things. Kitchens, they're important. They're an important part of our lifestyle, and so much money goes into remodeling them. And that's kind of just the way it goes, right? Nobody ever says, I need that knockout, converted garage area that I can use as my gym. I mean, maybe during the pandemic you do, but long term, you want car storage for cars, store all your stuff. Yeah, kitchen, bathrooms, those are the big ones people dump a ton of money into. Landscaping, another one, is a huge, huge money suck. And if you notice on the appraisal form, 1004 form from Fannie Mae and Freddie Mac, there isn't a single line for landscaping at all. It's not even recognized on the appraisal. Not even on the front page anymore, I don't think. Can't remember. No, there's not. You used to have to indicate front and rear yard, something like that. But landscaping, because it's not really relevant. It has to do with appeal when you go to sell the home, but it's not a factor like, okay, you got 2 bathrooms versus 1. It's one of those judgment call factors, right? So don't spend it on landscaping. That would be my bottom line, unless you're just dying to have one of those great rock retainer walls and cascading, ivy coming down. Oh, that'd be epic, wouldn't it? No. All right. That's it for me on this one. We have killed the home equity line of credit, the second mortgage, the cash out refinance versus rate and term finance. I hope you got something out of this one. I know it's not a very exciting one. We're not talking about Antifa here. We're not talking about depleted police numbers in various cities. But it's been a big trend, and it's been something that's been ongoing, is that people are sucking money out of the real estate market. And if you want to go down that road, I would recommend reaching out to your mortgage broker, reaching out to your personal banker, whatever, somebody that you know at a bank. Get a referral, get some options, shop around, compare. What I would really recommend not doing is going online and doing it. Meet with somebody, get a human body, somebody with an actual pulse that can tell you, hey, here's your options. Here's what you should do. Maybe you should think about this. Go down that route. All right, that's it for me. Thanks so much for being here. Thanks so much for supporting the Seattle Real Estate Podcast. I will catch up with you soon. Until then, be safe. Talk soon. Bye. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.